Hello, a warm welcome from Team Cafe Mutual. Friends, over the last few years, actively managed large cap funds find it difficult to generate alpha, especially after the introduction of TRI benchmarking. However, experts believe that large cap funds will perform better than mid and small cap funds. To understand more about the large cap market segment, today we have Atul Mehra, fund manager, Motilal Oswal Mutual Fund. Atul has an overall experience of over 15 years, 10 years with Motilal Oswal Mutual Fund and 5 years with Edelweiss Capital. Hi Atul, welcome to the show.
Thank you, Muzammil. Thank you for having me on the show. Thank you very much.
Yes, yes. So my first question to you is, what is your medium-term outlook on equity markets? What will drive the market and how comfortable are you with the valuations across the market capitalization?
Right. Thanks, Muzammil. So basically, the medium-term outlook is very constructive. So the understanding that is we have is in the medium term. If you look at India from a global perspective, it is absolutely standing out. We have a democracy, we have a strong leadership, and we have good quality corporate promoters and management teams who are driving business growth. Many of our companies, in terms of governance, is extremely strong as well from a global perspective. And from all these angles, we believe that India is poised for high growth in the next many years. If you look at it, our economy has been like the sixth largest economy in 2020. We will be the third largest economy in 2030, right? So as we are moving up in terms of GDP rank, a lot of our companies will also move up in terms of global market cap ranks. So that will enable wealth creation from a medium to long term perspective. And we believe that especially after the near term election result, you should see a lot of FDI and FII money coming in India. So which should drive GDP growth as well as in terms of returns on the stock market. So we remain very constructive on Indian equities in the medium to long term.
Okay. So, equity markets are touching new heights. What should MFDs tell their clients, lump sum or STP?
So I would say that firstly, it depends on the asset allocation. Like the most important power in terms of investing is asset allocation, and asset allocation is unique to every individual. So somebody who is in terms of early in their investment cycle and in their age profile versus somebody who is a senior citizen and so on and so forth. So the asset allocation is what matters the most, and from that perspective, anybody so today, if you look at it from that perspective, if you're looking to invest from the medium to long term, say 3 to 5 year perspective, we believe that equities as an asset class, it makes a lot of sense because the key with equities is you can compound your capital at a faster rate versus fixed income for a long period of time. And the way compounding works is that in the last 30 years, for last 21 years, the large cap index at 17.5% return has multiplied your money by 30 times. In the same time, if you're invested in fixed income at 7%, your money would have multiplied by 4 times on a pre-tax basis. So just look at the difference in compounding. And at 17.5, you are 30 times. And at 7%, you are 4 times over a 20-year horizon. So we believe if you have a long-term mindset, equities make a lot of sense. But having said that, fixed income also is necessary portion of the portfolio, and the allocation depends on each individual and its profile. So that is the thinking that we have.
Okay.
Yeah.
So, while Motilal Oswal Mutual Fund has been around for over 13 years, the fund house has only recently launched its large cap fund. Why this fund now?
So basically, we believe now it's the right time for a large cap fund from the perspective that if you look at the construct of the market, mid and small caps obviously have done very well in the last 2 to 3 years time, and we believe that the elections should be a key trigger where FII money in India will come about in a big way. So when 80% of all FII money in India is in the large caps, and in our opinion, as the money comes in India, you will see large caps do fairly well. So today we see an outsized opportunity for large caps, and we believe it's a good timing for introducing our large cap mutual fund to the market. And that's the reason we have the large cap NFO come in at this point in time.
Okay. But there are many large cap funds in the market. Why do you think MFDs should recommend Motilal Oswal's large cap fund?
Right. So I just want to share a screen here, basically just to talk about why Motilal Oswal Large Cap Fund will be so different. So basically, if you look at it in terms of the existing funds in the category, what you are seeing is that today the large cap category has like 30 funds who exist, and and they manage 2,80,000 crores in terms of AUM. But the key thing is the top 10 funds in the category, they manage 2,60,000 crores in terms of AUM. The top fund in the category manages 50,000 crores in terms of AUM. So what is happening is most of the money in the large cap mutual funds is with the top funds. And and many of these funds, especially the largest funds, for example, they manage 40, 50,000 crores in terms of assets. So typically what happens is when a fund size becomes very large, there is the mindset to hug the index and you follow a closed indexing approach to investing. So what we did was we looked at this data where if you look at the active share for every existing fund in the large cap fund category. So we looked at funds with a minimum AUM of 5,000 crores, which is 94% of the industry AUM in this category. Total 11 funds. Not even a single fund has active share of more than 50%. All of them have active share in this range of 0 to 50%. So normally active share of 0% is considered passive. Active share of up to 50% is considered closed indexing. Active share of more than 50% is considered active management. So the fund that we want to build will be built on three pillars of investing. One is it will have a high active share. So the index has 0% active share. The peers have 40% active share. We want to build a fund with a 60 to 80% active share. So that is the first pillar. Second is in terms of conviction. Our DNA of the house is conviction. Basically, if you look at the index, it has 100 names. Peers on an average have 58 names in their portfolio. We want to build a fund with 30 stocks. So it'll be a 30 stock portfolio. So that is the second thing. Third is if you look at the index and the peers, they are very, very top heavy. So if you look at this slide, you'll see that the top weight in the index is 11.5%. Top three weights in the index is 25%. And the top 10 weights is 50%. So in the 100 stock index, 50% of your money is going to the top names. And the balance 90 names have the balance 50%. So index is very, very top heavy. Even the peers, they are very top heavy. So we want to build a portfolio which is equal weight. So which means that our largest weight will be 3.5, 3.3%, and top three will be 10, and top 10 will be 33. Right. So with this combination of the three, high active share, high conviction, equal weight portfolio, we aim to deliver consistent outperformance. So the outperformance should come from high active share and high conviction portfolio. And the consistency will come from being equal weight in individual security weights. We will have a balance in terms of sector weights, and we also have a balance in terms of styles, quality, growth, and value, and so on and so forth. So combination of all three should help us derive outperformance on a consistent basis. And we believe that the approach that we are following in this fund is unique, and it is something which is truly differentiated. And the existing funds in the category, they are managed in a much more closed indexing manner. And our approach is true active management.
So, Amphi data shows that majority of large cap funds are not able to beat their benchmark. As a result, many investors prefer passive funds for large cap allocation. What is your view on this?
So our view is that it is not that the large cap funds cannot outperform. It is basically that the fund sizes in the category uh, have become so large that they are following a closed indexing approach to investing. Right? With closed indexing, you can't generate outsized alpha. Like for example, if you look at the data for the last 10 years, the best performing large cap fund has delivered 2% alpha, and the largest fund in the category has delivered 1% alpha. Right? So basically, if you look at the approach, because of closed indexing, they are basically having returns which are very close to the index. Now, we looked at some data for the last 20 years. So let me show you that slide. So if you look at the top quartile performers within Nifty 100, right? And we did this study for the last 20 years. We saw that the top quartile performers within Nifty 100 have delivered, and this is like calendar year data on and so on and so forth. So basically, the top quartile Nifty 100 performers on an average in the last 20 years have delivered 75% return versus 16% for the benchmark, which means there is 60% alpha potential if you're able to identify at the beginning of the year the 25 best winners within the Nifty 100. Now we understand this is the best case scenario, right? But what we are saying is if you follow true active management and try and select stocks which are potential top quartile performers and not select stocks based on their market cap weight, which is what the index is, right? Then you have a potential to generate outsized alpha in the medium to long term. And this is something that we want to pursue. It is not being pursued by the existing funds. And we believe that this particular approach should work. Additionally, I want to also show you how the portfolio construct for us will be very different. So of the 100 stocks in the index, basically we want to identify the top quartile performers. And this should form minimum 80% of the portfolio. So 25 into 3.3 is 83%. So this should be like the predominant part of the portfolio. The balance 15 to 20% is where we have full flexibility, where we plan to have our highest conviction mid and small cap ideas, stocks which we believe can be multi-baggers in the making. And additionally, we can do IPO and pre-IPO as well. Like for example, we want to reiterate this point that in a fund, basically your size of AUM of the fund is basically your biggest enemy in active fund management. So when you're managing a fund which is 50,000 crores AUM and you get a 30 crore allocation in an IPO, it doesn't move the needle in terms of returns. But when you have a 1,500 crore fund and you have a 30 crore allocation in IPO, it is 2% of the fund. The stock is 50% higher, it will contribute 1% to the alpha of the portfolio. But it will only contribute meaningfully if your fund size is small. If your fund size is huge and gigantic, it does not contribute anything meaningful. So we believe that other than the mid and small cap multi-baggers, even IPOs can be a strong contributor at the fund level, and which in our setting of a young new NFO should work better than any other fund in the existing category. So that's the thinking on why we believe that we should be able to generate meaningful alpha over and above what has been generated in the past.
Large cap universe are dominated by financial and technology sectors. In such a situation, how do you plan to offer sector diversification in this space?
So basically, in terms of the thinking that we have is our goal in running the fund is consistent outperformance. That is the goal with which we want to run the fund. And to deliver consistency, basically we need a balance in terms of sector styles and so on and so forth. So basically our goal is to identify better businesses. So select better businesses and stocks. And within each sector, within each style, you basically derive alpha from better superior selection. Now, if you're very way off in terms of sector weights, then that will help. That will like detract in terms of performance, and it will introduce volatility to the portfolio. So, in order to avoid that, we want to be broadly aligned in terms of sectors. But at the margin, we can be in terms of different. But broadly, we will want to have a aligned exposure to sectors and other factors like style, like quality, growth, and value, and so on and so forth. So with this, we will, in our opinion, be able to deliver performance on a consistent basis, which is the goal in running the fund. So that's the thinking there.
Okay, so that's all for today's episode at Cafe Mutual. It was an interesting session. Thank you, Atul, for your time, and thank you all for joining us. Have a great time.